Hey guys, today we're going to list the 5 best stocks to buy and watch now. Let's get right into it. Number 1, Visa. Visa is the world's largest publicly traded financial services company with a market capitalization of $431.58 billion. In 2021, it was responsible for more than 13 trillion transactions and collaborated with over 100 million merchants worldwide. Visa is sitting pretty as the world shifts away from cash and toward digital currencies. It also gains from the gradual increase in prices. This is due to the fact that its standard digital money model takes a small percentage of all digital transactions. Visa has a track record of exceeding market expectations. It is no longer the fastest growing provider of digital payments. However, its consistency and stability make it an appealing investment opportunity. Visa suffered a massive revenue loss in 2020 as a result of the pandemic, but has recovered with a vengeance. In response to the conflict in Ukraine, the company faced new challenges in 2022 when it withdrew its services in Russia. It also had to deal with the Federal Reserve's aggressive interest rate hikes to combat inflation, which had a significant impact on global exchange rates. Despite this, Visa reported a 19% increase in revenue year over year. Number 2, Alphabet. Alphabet is a multinational conglomerate formed in 2015 as a result of Google's restructuring. Alphabet, also known as Goog, is the parent company of Google and all of its subsidiaries. The company's mission is to make knowledge and information available to everyone on a global scale. The company's appealing valuation and balance sheet indicate that it is likely to thrive. Alphabet's most recent earnings report did not even mention the words slow or recession, which have become commonplace. Alphabet shares are currently down around 41% from their peak. This is thought to be due to broader market sentiment rather than Alphabet itself, and has resulted in the internet giant's lowest valuation in 10 years. Regardless, it has consistently increased its cash flow, revenue, and profits. Alphabet announced a $70 billion share repurchase plan earlier this year. Each share's intrinsic value will rise as a result. At the company's current performance rate, the money spent on the buyback could be repaid in as little as 5 quarters. Since the company went public nearly 20 years ago, Alphabet has remained one of the best stocks to invest in. Number 3, ASML Holdings. ASML Holdings, a manufacturer of semiconductor equipment, has fared better than many other technology companies during these trying times. While it has not been immune to the effects of the COVID-19 pandemic, it has fared well. Many investors are now concerned about how the company will handle the current economic crisis, as well as the threat of recession and inflation. ASML controls nearly 90% of the market for semiconductor lithology systems. Intel, Taiwan Semiconductor Manufacturing, and Samsung are among its most important customers. The firm has spent the last 2 decades developing the most advanced EUV lithology machines. These are now used to manufacture the world's smallest and most advanced chips. In the long run, ASML is expected to be a dominant player in supplying components to the world's semiconductor manufacturers. They have a monopoly on EUV lithography machines, which are required to continue producing smaller, more efficient chips. The semiconductor market grew by 26.3% in 2021, and ASML generated $9 billion in sales in the first 6 months of 2022. The company expects to end the year with a 10% increase in revenue over its total revenue of $18.6 billion in 2021. The current backlog confirms that the company's strong revenue growth is likely to continue. Number 4, Amazon. While Amazon's Q1 2022 results were lower than the e-commerce platform had hoped for, the company performed better in Q2 and surprised Wall Street with Q2 revenue of $121 million, exceeding all previous guidance and expectations. Furthermore, it reported an operating income of $3.3 billion, exceeding expectations by more than 10%. While Amazon is not a cheap stock, it is the dominant player in the global cloud services market. Furthermore, the company's infrastructure as a service model, which involves sharing costs and technologies, allows the company to rapidly ramp up or ramp down its services and capacity, resulting in increased business efficiency. With over 85% of organizations planning to use cloud-native technologies by 2025, now may be a good time to invest as Amazon expands in this market. Amazon is currently trading at 2.2 times forward sales, the lowest level since 2016. It also trades at a significant discount to its cloud-dominant rivals, Microsoft and Alphabet. In comparison to its competitors, Amazon is a labor-intensive operation. Higher wage inflation has an impact on its profits. Number 5, Exxon Mobil. Exxon Mobil saw its share price increase 4.3% following the release of its Q2 results. It was a mixed report with sales falling short of expectations, but profits exceeding expectations. Analysts predicted that investors would earn $3.74 per share, but the company earned $4.14 per share instead. Exxon's most profitable quarter ever was made possible by increased production, near record high oil prices and margins, as well as aggressive cost controls. Exxon's earnings increased by more than 280% year on year. Exxon generated exceptional cash flow and reinvested it into its refinery operations. Exxon's annual dividend has also been increased to $15 billion. That's all for today. We'll be sure to catch you all in the next one.